Alright, we're looking at tax compared with book depreciation. Book depreciation, well, the depreciation is a deduction from revenue on the income statement. We express depreciation as depreciation expense. The tax depreciation, well, the depreciation is a deduction from income, from the revenue on the tax return. The book depreciation is computed under GAAP, generally accepted accounting principles, and the business entity can choose among various depreciation methods. That would be the straight line, the units of production, the declining balance, and sum of the year's digits. Tax depreciation now is computed under the Internal Revenue Code, the IRC rule. The business entity is required to use Maker's depreciation, and Maker's, M-A-C-R-S, stands for Modified Accelerated Recovery System. Now, book depreciation, we're looking at the depreciable basis, which is the total cost of the fixed asset less the residual value. Under tax depreciation, the depreciable basis is the total cost because residual is always $0. Zero. Now, the depreciable basis under the book depreciation is used over the company's estimated useful life, whereas for tax purposes, the depreciable basis is expensed over the IRS determined recovery period. Now, for tax purposes, there's also bonus depreciation and Section 179, which will allow for accelerating tax depreciation deductions. Automobiles, though, have deduction limits that often reduce their deductions. Now, when we're looking at buildings, buildings are real property, they're real estate. And the real property has different tax rules from other property. It is depreciated under Maker's, the Modified Accelerated Recovery System, using the straight line method. Commercial buildings, business buildings, also known as non-residential buildings, are depreciated over 39 years. That's the IRS, the Internal Revenue Code. Residential buildings, they can be rental houses, they can be apartment complexes. Residential buildings where people reside are, according to the Internal Revenue Code, depreciated over 27 and a half years. Once again, both of these, they're real property, and you have to use straight line method for tax purposes. Now, depreciation of real property begins in the middle of the month it is placed in service. So if it's placed in service in January, it starts mid-January, like January 15th. Here's an example. If a building is placed in service in March, then depreciation begins on March 15th. You get half the month of March, and then all the months thereafter for the fiscal year. Here's an example of an IRS table for residential rental property. If you notice, along the left, those are the years, running from year 1 through, and it has 28, it even goes 29, because there are 27 and a half years for residential rental property. And again, depending if you're starting partway through year 1, then that could overlap not only into year 28, but it actually could go into that 29th year to get the full 27 and a half years. Across the top of the columns, you have the months from 1 through 12. So 1 would be January, 2 would be February, and so on. So that you can take a look now and say, well, if an asset is placed in service in February, then you would look at column 2, and if it's year 1, then the rate would be 3.182% that you would be multiplying times the cost, the depreciable basis of the real property. All right. Here they're giving an example. They say, for example, to depreciate rental property that's placed in service during March, a calendar year company that runs from January 1 through December 31st. So calendar year, the third month of the calendar year is March. Now if we're talking about a fiscal year other than January 1 through December 31st, the third month may not be March. You'd have to count. All right, so we'd have to use the third column for this from 1 year through all the 27.5 years. And year 1, it would be 2.879%. For years 2 through 9, you would be using 3.636. And after that, years 10 and 11, you can notice they're very close. It's that third decimal place that changes between 7 and 6. Again, they're pointing out that it takes 28 years to fully depreciate a property using straight line method over 27.5 years, because that first year you do not have a full 12 months. You would have 9.5. So then you're going to have to go into the 28th year. All these percentages, when you add them up, should add up to a total of 100%. To fully depreciate the property. Here again, for calendar year businesses or firms, March 15th through December 31st is 9.5 months. So the way they're illustrating how this percent has been computed, you would be taking 1 divided by 27.5 if you wanted to compute it, and that would be 3.636% for a full year. But since that first year is a partial year of 9.5, 9.5 divided by 12, when you do the math, that's where they come up with the 2.879%. It's been rounded to 3 decimal places. So here we have on March 1st, 2009, a calendar year company places in service residential rental property costing $100,000. So what is the depreciation for 2009 through 2011? Well, year 1 is 2009. You would take 100,000 times the 2.879%. As a decimal, that would be 0.02879. You can slide the decimal point over, and that would be $2,879. Year 2, it's 2010, and you're multiplying the 100,000 times 3.636%, or 0.03636 is a decimal, and that yields $3,636. In year 3, that's 2011, and you're using that same rate for year 3 as well. So that still gets you $3,636. Now, for non-residential real property, real property, buildings that are not used for individuals or families residing in them, non-residential would be your commercial property, your business property. There's a different table. This is the one because they have to use 39 years for the useful life. It is still computed using straight line. So we're looking at, it's much simpler, it's a short table. On the left you see the years. Year 1 is listed by itself, and then years 2 through 39 will use the same rate consistently for those years. And year 40, once again, if you're starting partway through year 1, it will overlap and go into that 40th year, even though the total number of years, 39 years. Across the top again, we have the months, month 1 of the fiscal year, month 2 of the fiscal year, and so on. If we're using a calendar year, then the month 1 is January. Month 2 would be February. If you're using a fiscal year that starts July 1 and goes through June 30th, then the first month of a fiscal year beginning July 1 would be July, and the second month would be August. All right, I just want to point that out in case you encounter a question about that. All right, so we're looking generally that IRS tables for property other than buildings, plant, and equipment, for example, they specify a 5-year or a 7-year recovery period for personal property. And we either use the DDB, the double declining balance, or the SL straight line method. We also assume that the asset was placed in service in the middle of the year, regardless of purchase date. Whereas when we were looking at the real property, we were assuming the middle of a month. They call that MM, or mid-month. Here we've got middle of the year, half year, HY for half year, middle of the year, regardless of the purchase date. Now there is an exception. Under the mid-quarter MQ convention, for mid-quarter MQ, when more than 40% of this type of property, personal property, plant, equipment, vehicles, when this type of property is placed in service in the last quarter, the last 3 months of the year, for a calendar year, the last quarter, the fourth quarter, would be October, November, December. So when more than 40% of personal property is placed in service in the last quarter, the last 3 months of the year, depreciation begins in the middle of the quarter it is placed. So the fourth quarter is October, November, December. Halfway through would be November 15th. So for a quarter, mid-quarter, you would get 1.5 months of the quarter, and then the remaining quarters until the end of the fiscal year. So they're saying here that if you purchase 40% of your personal property during the mid-quarter, during a year, then you have to use mid-quarter convention. They're calling it also Section 179 property that is eligible to be costed out, and we'll talk about that more later. We have ABC is a calendar year company. It places in service 2 assets during the year. The first was a machine that cost $21,000, placed in service on April 9th of 2009. The second was a machine that cost $15,000, placed in service on October 5th of 2009. Now, when you total that up, 21 and 15 adds up to $36,000. And then if you look at 15,000 divided by 36,000, you're going to find that that's more than 40%. So because more than 40% of ABC's Section 179 property, this personal property, was placed in service during the fourth quarter, ABC will start depreciating the first machine on April 15th, 2000.